9 a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets China Open. I'm Yvonne Man. The top stories this morning. Asian stocks gain after a big tech rally sent Wall Street higher, but Samsung hinting at persisting chip weakness with profit tumbling some 35%. China's authorities intend to throw more money at the economy. They indicate they may lower the RRR even after the PBoC boosted liquidity through other tools. And China's share of key emerging market equity benchmark drops to a record low, highlighting just how bearish the outlook is for the economy and how that's affecting investment sentiment. Certainly that's one to watch here, right? People are certainly willing to still go into that EM space with the exception of China here. We'll see if the news that we got from Xinhua, the PBoC hinting that we might see a RRR cut soon. We've heard comments like this from Zhou Lan before, and they do follow through eventually. Whether it's 2 weeks, whether it's 2 months, that's the question, right? If 50 futures are pointing positive, though, we didn't see that sort of follow through on Wall Street, and we saw on the NDRs or the U.S. listed sort of Chinese stocks in particular. So that goes to show how bad things are at the moment. This market urgent, needing some good news. We're talking about where Nasdaq futures are. Obviously, we saw Nvidia hit that record. That certainly lifted and reignited this whole AI rally. And we're watching very closely what happens when it comes to the CSI 300 after it did drop to that 5-year low. Flip of the boards, we're watching the rest of Asia. It looks like Japan coming back online here after that holiday, up close to 2%. So definitely catch up there. And we are seeing broad-based rally here across Asia. We're focusing on the chips in particular. So part of it is the AI trade. Then we have the Samsung Electronics. The stock is still up, despite what we saw when it comes to the earnings they're missing for the fourth quarter. And Taiwan Semi is up some 0.9% as that market opens up here today. Kospi is up 0.8%. Bonds in particular. So you had some Fed speak, the likes of Bostic, the likes of Bowman, saying, look, potentially we could see inflation getting back to that 2% target, and Bowman actually backing rate cuts if inflation falls further. So you did see that bond rally kick off once again, resuming, and we are seeing we're still around 4.02% for your U.S. 10-year, but that rally continues in the Asia session. Chinese CGBs also extending that rally 2.5%, still those yields at 4-year lows. And Japan, we'll watch very closely, right? Tokyo CPI cooled down, but still above the target. So what does that mean for the BOJ? We're watching the dollar moves. Of course, that drop that we saw in the greenback overnight certainly is lifting the most of Asia FX today. So the yen's back below 144. You have the Chinese currency at 716. Watching that fix very closely. And Taiwan dollar getting some strength here as we inch closer to that election as well. Oil markets, we're steadying a little bit, but certainly it's been a downtrend to kick off the year. We're still just around $70 for WTI. And we're watching Shanghai crude. There you go, reflecting that drop that we saw overnight. We're down more than 3% in China. And Bitcoin, so we're falling back a little bit, pulling back, but we did jump to that 21-month high here on the prospect that we're going to get that ETF approval pretty soon as well. So we're back below 47,000 this morning. For more on our top story now, PBoC's possible RRR cut. Let's bring in our Asia stocks reporter, Jeannie Yu, joining us now. All right, we've been dealing with so much bad news. How good news is this, that a RRR cut might be coming?
Yes, it is. It is on the positive side, one of the good news. But the key thing is, it's not the first time for PBoC to hint a cut and then follow up with a true cut 2 months later. The last time it happened, it took 2 months. It was not fast enough, and obviously it wasn't able to really revive the sentiment, to help the sentiment. So how is it going to be effective this time? It's a very, very big question mark with the stock market at 5-year low, and you got so many bad news. Like, to me, I don't think it's really enough to really help the sentiment. I think the investors still want more than that, to really, be convinced to get back to the China stock market.
What's still in the toolbox then, you think, that could actually get the foreign investors at least a little bit more positive?
I think in general, regulators need to make the market feel more comfortable. Like, their policies should be fast enough. they should be swift enough and, in reaction to some of the news. And also, some of the regulatory signals should be clearer. For example, like the regulatory tightening over the tech sector, which has been a key overhang for those heavyweights like Alibaba and Tencent. There is a consultation going on lasting through the end of January. So how that's gonna release a signal for that sector, whether it's gonna be renewed tightening, a more regulatory tightening for that sector, or is it going to be, an easing sign? I think regulators need to release that signal as early as possible. And also, there are some other stuff they can do, to ease investors' concerns. For example, over the shadow banking crisis, after all the news headline about Zhongzhi, and also, there are a lot of things to do. It's just like and I think investors they are waiting for those kind of signals, especially after the Central Work Economic Conference last December. Investors were all disappointed at the regulatory, it's not, they think it's not strong enough. There is not enough physical spending. I think many of that from regulators need to do more.
Okay. Jeannie Yu, thank you for setting it up for us here. Our Asia stocks reporter Jeannie Yu joining us as well. Staying on China now, President Xi Jinping is also pledging to deepen an anti-corruption crackdown and increase punishment for those who offer bribes. That's according to state media. Sectors highlighted include finance, infrastructure, pharmaceutical, and state-owned firms. Beijing's anti-corruption drive last year targeted a record number of senior officials, including high-profile bankers. And a lot of questions, of course, about the outlook for the Chinese economy. We have the annual UBS Greater China Conference on day 2, gathering top leaders in business and finance. Let's cross live to Shanghai and bring in Wang Tao, the bank's head of Asia economics and chief China economist. Wang Tao, always great to have you. Happy New Year. Just maybe tell us a little bit more of the discussions that you're having on the ground there at the conference. How are people looking at the Chinese economy this year? Will 2024 be better than last?
Right. Yes, I think there's certainly a lot of interest. We have a record number of investors attending the conference. Although I think the concerns on the economy remains, people are concerned that the property market, the property activities are not yet stabilizing. People are looking out for any policy support, policy announcement that's coming through. And also, of course, people are looking at a possible U.S. election and the impact for the rest of the world as well, and concerned about U.S. growth slowdown and looking for the timing of U.S. rate cuts. And does that provide more room for the PBoC to also ease monetary policy? So a lot of the issues are in focus.
Yeah, I got to get your take on that triple R cut. The reports that the PBoC might be close to implementing a cut of some sort. Is that going to be some sort of game changer for the economy?
I'm afraid not. I think we are expecting, 25 to 50 basis points of triple R cut early this year. We're also looking for 10 to 20 basis points of rate cut as well, probably by second quarter. But that is really a modest policy easing. I think the real effort has to come from fiscal. So we are looking for fiscal deficit expanding. We're looking for another 1 trillion special treasuries. We're looking for larger local government debt swap bonds and a lot of more debt restructuring. I think fiscal need to play a bigger role and be more supportive. But at this moment, we're not looking for anything really big, given that there is really tightening forces within the local government finance, right? So that's why we think the overall economy, we're looking for around 4.5% growth only this year, so 4.4%. It's still a year of consolidation.
I was asking your colleague Tommy Fang yesterday, what would be on his wish list in terms of the policy front for the market to turn around? What would be on your wish list, Wang Tao, for the economy to at least see more signs of bottoming out?
Right. I think on my wish list is more support for the property sector, including credit support to property developers that help to stabilize the property activity. I wish that the government push out more fiscal stimulus, especially to the household sector. Short of that, I think increased spending on the social sector, including pension and healthcare, that will improve people's confidence about their future and increase consumption. And then, following that, also more support to local governments and infrastructure spending. So those things, I think, together will really help stabilize the economy and show the market that the government is on the ball, and then the economy is going to stabilize and improve from here.
And you've been kind of reflecting a bit about last year. I mean, when people thought that, probably the biggest surprise was the exit from COVID zero. And yet the economy didn't quite play out the way that we all thought, right? We thought that inflation was going to pick up because of, the pickup in services and the like, and the property market would at least stabilize. What do you think was wrong in that equation?
Well, I think there are a few things. One is that Chinese household, I think balance sheet confidence was scarred. Their income growth was slow after a long period of COVID, right? 3 years compared to the rest of the world. So consumption recovery was weak, especially without any government support. So that's one thing that's different. Secondly, I think the property sector did not stabilize, and it went down. It rebounded first, but then it went down from there. So in the deepest property downturn really hurt consumer confidence and the overall economy. And that in part maybe because the government did not come out with any policy support early on. They came out later in the year, but it was after the fall had already deepened. And then also on the fiscal side, local government were cutting wages and owning arrears, cutting their general spending to help keep their debt payment current. And so in effect, China was running a fiscal tightening, a tight fiscal policy. That certainly did not help demand or confidence. So I think a number of factors that were at play that really made the economy disappoint. And that prices, China still have a lot of surplus labor. Services were hit very hard during the pandemic. So there was no really services price increase. So that was very different from the rest of the world. And so the deflation, price decline, also, of course, hurt confidence, hurt profit for the corporate sector. So real growth looks fine, but nominal growth, which matters for profit, for revenue, for debt payment, those were very weak.
And you're actually thinking that China can get out of this whole deflation environment this year. What makes you think so?
Well, so I'm cautiously confident. On the CPI front, I think big factors are pork price and energy price. Both declined quite sharply last year. Pork price was especially surprising. So at this current level, we don't really expect that kind of decline. We think there will be stabilization, and pork price will go up, so that helps. But on the core CPI, which has been around 0.5% or so, that's been quite weak. So we assume in our baseline forecast, we assume property activity will stabilize. And so in that case, then the core CPI can stay stable. But there is, I have to admit, there is, so the baseline, we're going to climb out of it, but there's considerable risk that if property does not stabilize, we could, plunge into deflation for longer.
I'm going to end on a positive note. What do you think? What surprised you in terms of the resilience of this economy? What actually stayed or held up at least, and what can actually you think can kick on at least in 2024 in terms of the positive parts of this, the bright spots of the economy?
Right. Well, so even if when we look at the bright spots, so there are still, the services consumption is recovering and household income is recovering. Household income growth grew by more than 5%, close to 6% in the first 3 quarters. And the labor market is improving, although it's still very weak. I think that's going to continue this year. So we are looking for household consumption to grow at around 6% this year. And then also in despite the fact that China's overall export was weak last year, part of that is really driven by the global tech cycle, which was down. This year, global tech cycle has swung back. So we are looking for exports to improve in China. And of course, in the manufacturing sector, the traditional sector, the property, infrastructure, all have stayed weak. But there are vibrancy in a lot of the new sectors, including electric vehicles, the green transition. There's still a lot of innovative companies emerging in this very competitive landscape. So these kind of transition, shifting to new growth drivers, to the more vibrant parts of the economy, that's still going to continue this year.
Wang Tao, we're going to leave it there. Thank you so much. Head of Asia Economics and Chief China Economist at UBS. Of course, we have plenty more guests coming through. Day 2 at the UBS Greater China Conference from Shanghai in the coming hours. That includes an update on the world's growth outlook with UBS Head of Global Economics and Strategy, Aaron Captain, and a conversation with Shanghai Chongyang Asset Management President Wang Cheng. All right, we are checking that reference rate coming through here, and it is another strong support from the PBoC, 710.10. The estimate was around 500 pips above that, so certainly another strong sign here. Just given the dollar drop that we saw overnight, renminbi was actually unchanged in terms of the offshore rate here, so we didn't quite see that positivity play through for the currency. 716.26 right now for dollar China. Coming up, we're going to dig into Samsung's latest earnings after the firm posted its 6th straight quarter of declining operating profit. Got plenty more coming up. Also, live pictures out of Taipei here with the DPP presidential candidate Lai Ching-te. There is his counterpart, the vice presidential candidate here, Xiao Meijing. They're speaking at a rally here this morning, talking about maintaining the status quo and Taiwan's policies. This is Bloomberg. Well, Samsung has reported operating profit for the 4th quarter that missed estimates. Let's bring in Edwin Chen now joining us with the stock unchanged here at the moment. But what do these numbers tell us about the plight of the global smartphone and memory chip industry?
Plight is a good way to put it. I think in some, it's always hard to read into just 2 numbers. But in some, I think it tells us the recovery is perhaps going a little slower than most of the industry anticipated. It suggests that consumer spending and the memory chip market remain persistently and stubbornly weak.
Yeah. So what does this tell us with the timeline then? When are things going to bottom and when are things going to recover more?
I think a lot of investors are going to be a bit more cautious about predicting a swift or swifter rebound. I think, a lot of the market went into 2024 hoping to put the worst of the years-long slump in consumer electronics, smartphones, and memory chips behind them. I think what today's numbers kind of tell people is perhaps to hold on for a little while longer, and that this recovery may be an extended one, or a gradual and slower one than projected.
Yeah, the divisional breakdown, that's always the key one at the end of the month there. What would you like to see, I guess, or what are we expected to see?
I think a lot of analysts want to hear more about their AI efforts, something called high bandwidth memory. I think, Samsung is in the unusual position of playing catch up to much smaller Hynix in this field. I think the investors want to hear what they're going to do to bridge that gap. How are they going to invest to really take back the technological lead, and that's what's going to catalyze the stock going forward.
Okay, Edwin, thank you. Edwin Chen there joining us with a breakdown of those Samsung earnings, and certainly the stock hasn't really quite moved here this morning. We're going to take a look at chips, though, because that certainly has been doing quite well here today, thanks to the news on Nvidia jumping to a record high to help spark an overnight tech rally on a slew of news from the chip maker. First up, it was them unveiling 3 new desktop graphics chips to help their customers with AI PCs. Now, that's sort of the new era that they're kind of embarking on. The firm says the new technology would allow users to make better use of AI on their personal machines.
Looking forward, AI experiences will be delivered with a hybrid of cloud and PC computation. Hybrid AI will use Nvidia GPUs in the cloud to run the largest language models. And in gaming, a combination of AI in the cloud and PC will pull you deeper into the story. A new era of PC computing is here, and it will transform everything we do. Nvidia and our partners are excited for what comes next.
All right. Well, meanwhile, Reuters also reported that Nvidia is also planning to start mass producing an AI chip designed for China to comply with U.S. export rules in the second quarter. Some news out of the U.S. as well. JetBlue CEO Robin Hayes is stepping down next month due to health reasons. Now, sources tell us that his decision came at the urging of his doctor, but he doesn't face an immediate threat. Hayes led the carrier through a recent failed partnership with Alaska Air and the pending acquisition of Spirit Airlines. Joanna Garrity, currently JetBlue's president, will become the first woman to lead a major U.S. carrier. Tiger Woods and Nike have ended their partnership of more than 27 years. The company struck its first deal with Woods in 1996, the year he turned professional. But unlike subsequent deals with NBA stars LeBron James and Kevin Durant, Nike did not sign him for life. It's estimated Woods earned about $660 million from the relationship. The 48-year-old posted on X that there will certainly be another chapter. Barclays says its global headcount dropped by about 6% over 2023. It's the most visible sign yet of the bank's cost-cutting push. Most of those affected are within the group's support functions, reflecting the removal of management layers and improved technology and automation capabilities. But the lender also says it continues to selectively hire front office roles in key businesses. We got plenty more ahead. Your agenda and your China Open, what to expect here today coming up. Futures pointing slightly to the upside here today. This is Bloomberg. Another net drainage here when it comes to liquidity from the PBoC here today. So we're talking about 157 billion yuan in open market operations. So certainly after what we saw was this unprecedented injection in December, we're pulling back a little bit as we kick off the year. One to watch here is this chart, right? So this is according to Bloomberg calculations of China's weightage in the MSCI EM index now. That continues to fall. We're talking about around 20-some% now. And that is probably one of the lowest that we've seen on record, according to Bloomberg calculations. I think Goldman has it around 26%, which is a 2007 low of some sort. But certainly that just goes to show how bearish people are about China, but still willing to get into the EM space. And does that mean that economic spillover from China to other parts of EM, that's starting to wane a little bit as well? In terms of the agenda here today, as we think about that a little bit more, what to watch, of course, we talk about the 5-year lows here for the CSI 300. CGB yields continue to be seeing this rally in the bond market. We're in that window for credit data as well. We talk about tech, chip, travel stocks as well. We talk about the record air travel during the Lunar New Year holiday. And we got the Open coming up next. This is Bloomberg. You're watching Bloomberg Markets China Open. We're just about less than a minute away. And right now, we're hoping to see maybe some upside here, given the hints that we've been seeing from the PBoC dropping, that they might cut that triple R cut, and as well as some other tools in their toolbox here in the coming weeks or months. We're not sure in terms of the timing as well. Obviously, whether it's 2 weeks or 2 months certainly does matter for the market as well. But at least today, you are seeing slight gains in the pre-market in Hong Kong. But really, you take a look at the rest of the region. Who would have thought, right, that we thought kicking off 2024 was going to be on a sour note, and things really reviving again when it comes to AI. The whole Fed narrative once more talking about potential rate cuts, and Bowman from the Fed also backing rate cuts here in 2024 if inflation continues to slow down as well. So certainly the inflation discussion is going to dominate this week, given what we're seeing in the U.S., China, Japan. We already saw those Tokyo numbers here this morning. So right now we are seeing some green arrow story here in Shanghai as well as in Hang Seng. Keep in mind, though, we did reach those 5-year lows for the CSI 300. HSCEI also, I think, we're around 14-month lows as well yesterday. So sentiment looking a little bit better. HS Tech is where it's catching that bid. You got to thank Nvidia in some ways on that story. Maybe a less so on Samsung. And that's really kind of driving the whole tech gauge here this morning. And CGBs, we're still seeing that rally. There you go. 250 for your Chinese 10-year yield. Keep in mind, we're just about, give or take, 20, 30 basis points away from that low that we saw since 2002 for the Chinese 10-year yield. So certainly one to watch on, the rate cut bet's really been piling up, and you're seeing that priced in this market. So it goes to show, if we do see a triple R cut, is it already priced in? Are we really going to see a big market reaction, right? There you go. As we speak, CSI 300 turning back into negative territory. We're down about 1/5 of 1%. It's a mixed picture across sectors here, but you are seeing a slight bid when it comes to developers here this morning. It's the tech space that's still looking pretty strong, though. But consumer staples, industrials, financials still looking a little bit weak. In terms of what, we'll focus on the tech space because it was the Nvidia story, really, that reaching that record high. Then you talk about, rolling out some new chips. And so this whole fever is back, right? You're not quite seeing that in Tencent and Alibaba, which is interesting. But Baidu, that's up 1%. 360 Security Tech as well, also up some 1% here right now. We're also watching these chips, just given the Samsung story. But we are seeing actually a slight bid when it comes to SMIC. Huahong doing a little bit better, up 1.5%. And we're watching some of these shipping stocks. So there was some reports from Europe overnight talking about maybe there was a potential Red Sea passage deal that was reached. You have the likes of Maersk and them denying of any sort of deal. So they dropped pretty heavily in the European session. So you are seeing the likes of Costco shipping down about 4.5% here today. Let's bring in Jasmine Duan, Senior Investment Strategist at RBC Wealth Management Asia. We turn the page. It's 2024. It doesn't seem like anything in terms of sentiment has changed when it comes to China. Does a triple R cut potentially coming on board, does that change anything for you?
Yeah. Right now at RBC Wealth Management, our view hasn't changed much compared to December because we think investors have increased their bar for investing in China. And the major concern remain the same. Geopolitics, growth outlook, and also the policy uncertainties and predictability. And even though the PBoC and the government said they are going to announce more easing measures, we don't think that's going to be a game changer at the moment. I'm just wondering, the Fed discussion is getting more positive. Why hasn't China benefited from that, or Hong Kong in particular? I think a lot of the concern still goes to the long-term investability of China, and especially for the foreign investors, when they are concerned about the growth outlook and also the policy uncertainties, they become more cautious when going to invest in China. So we think overall, the Chinese equities is going to trend in a limited range in the near term. But having said that, maybe we can find some selective opportunities and to gain extra return by seeking alpha. Okay, where do you seek alpha then now? So right now, we pay a lot of attention to bottom-up company and sector picking, and we think companies that are going to benefit from policy tailwinds and they have a comparative advantages are going to outperform. We also like companies that have demonstrated their capability to expand their overseas market. And we continue to like the high dividend yield stocks because we think they are going to provide some protection and stable income in 2024. Okay. So not much has changed really for you in terms of China. I'm just wondering in terms of the U.S. though. I mean, we're getting a bit of a bounce back here as we kick off this year. It's interesting, right? We all thought that maybe the December and November gains were overdone, and then we see something like this happen again. Was this just a healthy pullback that we needed for risk assets, or do you think this is a start of some sort of risk-off sort of shift? So at RBC Wealth Management, we remain constructive on U.S. equity in 2024, and we do think currently it is a very healthy pullback, and given the very strong rally at the end of the year. So right now, our year-end target for S&P 500 is 5,000, and but we do expect heightened volatility during the year, given the recession scenario, how to play out, and when the Fed is going to cut interest rate, and also it is a election year. So typically, we will see more volatility in an election year. Okay, how does that play out for markets then? Is it more noise, or do you think that there's all this prospect of Trump 2.0 being quite disruptive?
How so?
Yeah, so election year typically creates more noises for the market, and it usually follows a typical pattern. It starts very weak at the beginning of the year and gradually rally towards the election, and it continues to rally after the election. But when it gets close to the election day, we will see more volatility. However, since 1928, the S&P on average have a 7.5% return, and 75% of the time they will end up in positive territory. Okay. So we shouldn't be too negative on the outlook this year.
And is AI still something that you're pretty positive on this year?
So currently, we continue to like tech because we think it is going to deliver strong earnings growth. But in the near term, we do think a healthy pullback is needed for it to continue to lead and to have a very healthy uptrend. And also, we think investors should add more protection and add more high-quality stock this year, so to diversify the portfolio. So healthcare sector may be a good sector for investors to look at.
How do you look between stocks and bonds right now in the U.S., right? I mean, obviously we've seen this massive rally in the bond market. You have the likes of Bill Gross saying 4% for the 10-year is still overvalued. I mean, which one do you lean more towards, stocks or bonds? Yeah,
right now the bond yield is really attractive, and that really creates some competition for investors. So we do have a positive view on bonds this year. But having said that, it doesn't mean that equity may have a negative return, because in the 1990s, the yield gap between equity and also bond is similar to the current level, but the equity still deliver more double-digit return on an annual basis. And also, don't forget, the inflow into the U.S. bond funds doesn't only come from the U.S. equities, it also comes from the non-U.S. equity markets. So geopolitics also play a very important role in the fund.
What about the BOJ then? That's also a big part of how much they own as well in terms of treasuries.
Yes. So BOJ, when they are going to adjust their policy, is also a big question to investors right now. And we do see the BOJ want to provide more time and more clarity to the market, so they are not in a hurry to adjust their policy. Maybe towards the second half of the year is the right time to adjust.
All right. Jasmine, thank you. Jasmine Duan, there, Senior Investment Strategist at RBC Wealth Management Asia. Let's get to one of our other top stories here. Boeing has taken the first step towards returning its grounded 737 MAX 9 jetliners to service, as it's issued guidance to airlines on inspections to prevent another mid-air blowout like the one Alaska Airlines experienced last week. The U.S. FAA says carriers must complete enhanced inspections before planes are allowed to fly again. Let's get to our Asia transport reporter, Denny Lee, joining us now with the latest.
Yeah, so as you said at the top, Boeing have said that they want to, they're going to be staying in close contact with operators on these inspections. But it's this statement which has come out. It emerged after United Airlines, which has started conducting its inspections. So they're the biggest operator of the MAX 9 jet.
Yes.
They've already found some installation issues, as they've called it. We've reported several jets have discovered loose bolts in the door plugs. So that is a significant development that has happened overnight. And as Boeing does get ready to get these aircraft back into service with the help of the airlines, these inspection process that it has to go through, there is now a question over whether there has to be some amendments to what Boeing has initially put out in terms of the inspection requirements, and that will ultimately need the full sign-off of the U.S. Federal Aviation Administration.
As we continue on, I mean, it seems like this is a long the investigations and stuff is going to take some time to really play through. There's an interesting column from our columnist, Tim Culpin, about maybe this is a chance for China to maybe take advantage of this, for COMAC to maybe to secure some orders or of the like. I mean, how big of an opportunity would that be?
It's unlikely for it to be an opportunity in the meantime, and especially given the constraints in the overall aviation industry, especially in the supply chain space. And COMAC still hasn't really proven its credentials. So for COMAC at this stage, very unlikely. But for the reputational damage, as we've been saying for the last 24 hours for Boeing, is still pretty significant. Yeah. And ultimately, whether this installation issue is the contributory factor or the primary factor, that's still going to be something that the investigation has to follow.
What are they mostly focused on, investigators, now?
I think they're still fact-finding. They're fact-finding, as we heard from the NTSB, the National Transportation Safety Board, in their press conference yesterday. So that was Sunday night in the US. They will have a press conference also coming up in the next couple of hours. they're still gathering as much information as possible. They only found the door plug that had blown out yesterday, very late on. So that's going to be poured over for analysis. And any information that they can get, whether it be from the airlines in terms of how they've been maintaining their planes to systems, that's still going to take quite some time, as you said. Several weeks to come.
Yeah, you've been focusing on this story. There's another story here in Hong Kong happening, which is Cathay Pacific. You're reporting a little bit more about maybe some sort of union meeting or some sort here. What's happening?
So the Cathay's pilot union, they're not recognised by the airline anymore, but they've now come out to say they want to see a government inquiry into how Cathay's been handling mass cancellations. And this is all in response to how the government and the government's transport minister came out to say he's very concerned about what Cathay has been doing and how it's been handling the situation. And we've calculated now that there have been 200 flights cancelled since Christmas Eve. Wow. And there's still going to be more through January and through February.
All right. Could be something for us when we travel for Lunar New Year. There, Danny Lee, thank you, our Asia transfer reporter, joining us there when it comes to Boeing as well as Cathay. That upcoming news coming up through. Coming up next, we're going to talk about Taiwan. Days before a high-stakes election that will set the course for U.S.-China relations for years to come. This is Bloomberg.
The key to maintaining peace and stability in the Taiwan Strait lies in adherence to the One China principle. And China firmly opposes any separatist actions for Taiwan independence. The Asia-Pacific region is a promising land for peaceful development, not an arena for major power confrontation.
Chinese Foreign Ministry spokesperson Mao Ning speaking in Beijing yesterday, talking about what is, of course, at stake here when it comes to this Taiwan election. And you're seeing live pictures right now out of Taipei with the DPP having their pre-election briefing here this morning. There is his counterpart, the vice presidential candidate, Xiao Meijing, talking there this morning. Talking about also what the whole China and cross-strait relationship could look like here. Lai says he's willing to work with China on an equal footing as well. And of course, tensions with China are at the top of voters' minds as Taiwan prepares to elect a new president this Saturday. Ruling party candidate and Vice President Lai Ching-te says he's determined to safeguard the stability at the Taiwan Strait and work with China. And he's among three contenders making their final push to whip up support. Our very own Stephen Engel reports from the party's latest rally.
Taiwan's presidential election campaign is into the home stretch ahead of Saturday's critical vote, with rallies across the island this week. Strained relations with China and talk of possible war make this one of the most consequential votes Taiwan has ever seen. We traveled an hour southeast of Taipei to Yilan, where the ruling DPP met its faithful in a raucous evening rally. Now, unlike the opposition KMT and TPP parties that favor closer links with mainland China, the incumbent DPP prefers maintaining a status quo of de facto self-determination and building a fairly sovereign Taiwan identity internationally. Taiwan President Tsai Ing-wen here in Yilan stumping for the candidate she hopes will replace her after 8 years in the Taiwan presidential office. That is her Vice President, Lai Ching-te. Two leaders Beijing has branded as separatists. China has repeatedly warned that any pursuit of independence could lead to military action against Taiwan.
Warships and fighter jets keep coming from China as intimidation. When we have such an aggressive neighbor, we must protect our territory.
China has definitely interfered in the run-up to the vote. Missiles and fighter jets are some examples, but it only pushes people to vote for the DPP. Sometimes the interference is simple and obvious, like through TikTok and other social media platforms. I want more legislation on national security. It will be safer, especially cybersecurity-wise.
Taiwanese are distinguishing between autocracy and democracy in this election. People are worried about casting the wrong vote and losing freedom and democracy for generations to come. This is why people feel this election is so significant.
I support independence. There are challenges facing Taiwan to gain international recognition. But Taiwan does deserve a place in the international community, not blocked by China.
Yes, but does a live victory mean we're closer to war?
I don't believe so. If China wants to attack, China would have attacked long ago. Taiwan is actually very easy to defend. Taiwanese people want to continue to rule itself.
Stephen Engel, Bloomberg News, Elon, Taiwan.
And Steve will be reporting from rallies for the two main opposition parties, the KMT and TPP, later on this week as our special coverage out of Taiwan continues in the lead up to the vote on Saturday. Plenty more to come. This is Bloomberg. All right, let's take a look at Bitcoin now. We rose briefly above $47,000 for the first time since April 2022. On optimism, the SEC is poised to approve a spot Bitcoin ETF. Let's bring in Sue Keenan joining us now with more. We've pulled back a little bit, Sue, but we're starting to hear BlackRock, ARK, and several other prospective issuers of ETFs filing amended forms in what analysts are seeing as the final step here.
Yeah, and it's the filing of the forms that really caused Bitcoin to take off in the earlier hours. What we saw was Fidelity, BlackRock, ARK, Invesco, WisdomTree, among the firms that filed amended applications to offer the ETFs with the SEC. There are two technical requirements that have to be fulfilled before a spot-backed Bitcoin ETF can start trading, since the SEC must sign off on the so-called 19B4 filing by the exchanges that would list the ETFs. And the second is the regulator must approve the relevant S1 forms. We saw those filed as well. And the combination of those two filings, which analysts say is the final step before an approval, as you can see, really caused Bitcoin to rocket higher in the latest session. Now, notably, the SEC Chair Gary Gensler posted a note of caution on X. Of course, he's been opposed to granting a spot Bitcoin ETF for years. He warned that crypto investments can be, quote, exceptionally risky. He pointed out some platforms have become insolvent, and he said such investments continue to be subject to, quote, significant risk. A lot of Bitcoin enthusiasts thought he was throwing shade on the process, but when you consider Bitcoin is now pushing to levels not seen since before the collapse of the crypto sector in 2022, many believe this is a real strong sign that approval is imminent. Meanwhile, there's been a rush by some prospective ETF issuers to cut their fees, notably Grayscale, which up until now has really been the only game in town, and analysts had predicted that what we would see was a more competitive posturing as we get very close to this being a reality.
Okay, as you mentioned there, things are cooling down in the Asia session, but 50,000 seems to be within reach. What's the outlook there, Sue?
Yeah, you mentioned again, let's just talk about the rally taking a bit of a pause, because we saw Bitcoin jump to that level that not seen in over a year or more. What you saw was a lot of the other coins rise with it. Now they're pulling back just a bit, as makes sense. But the projections of crypto advocates are pretty strong. They're targeting 50,000 as the next price level for Bitcoin. As you may recall, Bitcoin touched an all-time high of almost 69,000 in November 2021. It last traded at 50,000 in December of that year. And we're getting a lot of bullish reports from different banks. Notably, Standard Chartered Bank estimates that between 50 to 100 billion of inflow into Bitcoin ETFs this year will be fueling the rally. And that's why all the excitement is now taking place. Again, January 10th is the date that the SEC is expected to give a decision.
Yep. Pretty soon, the next 24 hours or so. Sue, thank you with an update there on what's going on with Bitcoin. And I check on the markets there. So there's a cooling in Bitcoin, but the rest of the Asia really still catching up to what we saw in the Wall Street section. But there you go. Shipping stocks are doing the opposite here. Take a look at that. There was news on this Red Sea passage deal. Some European shipping companies have denied that, but you have seen the likes of Costco shipping, for example. Their booking ships to Israel as the Houthi threats grow there. So you are seeing the likes of Costco shipping down some 4%, Orient overseas, that's down some 8% here this morning. So the geopolitical risk certainly is playing out in some of these shipping stocks here today. And we're watching chips very much in focus. So Samsung, that was a disappointment in the fourth quarter. But still, the stock's down 0.8%, but look at the rest, right? If you take a look at these chip stocks, we're still doing quite well. You got to thank Nvidia for that, right? Talking about these new products and really reigniting this whole AI fever across the Nasdaq as well as what we're seeing in the Asia session here. So the likes of Huaheng Semi up 1%, SK Hynix is still up 2% here right now, and we're watching China there, still underperforming the rest of the market, just given that it's pretty much risk on. If you take a look at risk assets here today, so CSI 300 still in negative territory. Marginally, though, we're talking about 1/5 of 1%, but still extending those losses now after reaching those 5-year lows. HSI still recovering a little bit, but still, take a look at the rest of the dashboard in Asia and what GMM is looking like here. It is a sea of green. Thanks to Nvidia. We also had some Fed speak talking about, look, Bostic thinks we can get back to 2% inflation out of the U.S. Bowman saying, she'll back those rate cuts if inflation continues to wane and slow down. So there you go. That's igniting. Stocks up. Bonds are up once again here as well. Chinese 10-year yields are down another 1 basis points here, and the dollar dropping for most across the board here. Dollar yen seems to be the key strength here, with commodity markets still seeing a bit of red here this morning. CSI 300, there you go, just below that 3,300 level. We got plenty more to come. This is Bloomberg.